Hello, everyone. Thank you for watching CCN Game Changers. Extraordinary people impacting our everyday lives. People and events, actually. I'm Tammy Devine. You're probably well aware of the mortgage mess that many say sparked the recession we've been in for the past few years. Now get ready for the game changer. If what my guest Joe Vera alleges is true, some very powerful people ought to be in jail right now. Investigations are underway, and Joe Vera of Joseph Daniel Consultants says the findings should be clear. Joe is our guide today throughout today's CCN Game Changer, The Mortgage Mess. Thanks so much for being here, Joe. Really appreciate it. Right. It's good to see you, as always. Let's start at the very beginning. How far back would you say this mortgage mess goes back? To decades, to
I wrote
presidents?
an article, I would say 1913 with the Federal Reserve Act, but I wrote an article way back when the savings and loans crisis took place. I called it a training camp for what would eventually happen, and we're here. And this is disastrous. We haven't seen the consequences of what these banks have done to America. They should be in jail. People at the very highest places should be in jail.
Okay, all right. I want to get to that, about exactly why they should be in jail. Now, some people talk about the Community Reinvestment Act back in Bill Clinton's time. And some people say that maybe that had something to do with it. What are your thoughts on that?
Well, it did begin with that era and with the interest rates being dropped by the banks. Everyone knew that when we would drop the interest rates so low that prices would go up. I distinguish between the word prices on the one hand and values on the other. Real value didn't go up. What we created was a bubble. And the banks are enjoying that bubble.
Yeah. They benefit from it, and some people talk about the Fannie and Freddie, too, yes. I guess, being the very start of that. Can you kind of explain to people, and, you know, if you could explain it, I know you're an expert in all of this stuff, but if you could explain it as simply as you possibly can for me and for people watching,
sure.
You know, just how the mortgage issues with Fannie and Freddie kind of caused some of this.
Sure. With the interest rates being dropped so low, we created a lot of loans. Now, Fannie and Freddie have been a secondary market. They buy loans that lenders create. But with the interest rates so low, we got different organizations, people, companies, hedge funds that would pool the loans so that they could sell them to Wall Street, basically American citizens, localities, universities, states, other countries. To give you one example of the disaster that they did cause, they being the banks, Harvard lost $500 million because of this pooling. They aggregate these bad loans and they would sell them. That's part of what they did.
And when you say they, you're saying that the banks would, that made the initial lending would gather all of the bad loans that people could not repay back, sure. And then they'd sell them to government-sponsored enterprises.
That's
like
correct.
Fannie Mae and Freddie Mac.
Exactly.
Right?
And then entities similar to Fannie Mae and Freddie Mac were created to buy some more of these toxic loans from the banks.
And that's where the criminality that you're talking about comes in, right?
There's so much, but I'll give you a couple of bullets. The banks, with the help of their friends in politics, went to the Financial Accounting Standards Board. They create the rules for accounting for non-government entities. And what the banks were able to do, they got Rule 157 suspended for them, and this is what that means. Rule 157 is the rule used to evaluate an asset. So, for example, if your $1 million house goes down to $500,000, if you go to borrow money, you have to report that you have an asset that's only worth $500,000. The banks do not.
Okay.
They can still show the $1 million value on their balance sheet, and they go out to the world and say, invest in our company based on that $1 million value, which is not true. It's hot air. It's
right,
nothing.
Right. It's a lie.
It's a lie.
But the rules and regulations allow them, the federal rules allow them to be able to do that?
The Financial Accounting Standards Board, encouraged by the government, allows banks to do that. That rule, Rule 157, has been suspended for banks. It would be nice if a property owner could go and say, my property is still worth $1 million.
Yeah. Well, okay. That's starting to make sense here. So, when you lower interest rates, and I know you have information, I think, on some cards that I'd love to see. You know, I love show and tell that you can show us here. But when you lower interest rates, you're saying that was part of the problem. That it's a problem that the interest rates were so low for some potential customers. Is that right?
Absolutely.
How so?
When you lower the interest rates to the level that they were lowered, that is going to encourage mortgage brokers, real estate agents, and people that want to own their first home to take risks they wouldn't otherwise take. And some of them did it improperly. They should not have done it. But they did not lower the interest rate. They were not encouraged, hounded by banks. I speak to thousands of agents, to fix the appraisal, to fudge a little bit on the loan application. This began not because the homeowner signed a note they should be paying on, but because the banks lowered the interest rates, and everybody has a right, it's contract law, to expect fair dealing, good faith and fair dealing from the banks. And as you'll see when we talk about MERS, there is no fair dealing here.
There is no fair dealings. Okay, I can't wait to get to MERS because I think a lot will be shed, a lot of light will be shed there, excuse me. But you wanted to show us, I think, some cards. So if you can kind of hold them up. If you want to, and kind of point and tell us what you're talking about on the interest rate cards.
On the pools of loans. Let me read this quote from Senator Carl Levin. They bundled toxic mortgages into complex financial instruments, got the credit rating agencies to label them as AAA securities that had no business ever earning top ratings, and sold them to investors, and all too often betting against the instruments they sold and profiting at the expense of their clients. So they created this rise in value, and then they bet, it's called shorting in securities, they bet that the value would go down, and they made money coming down. So they made money going up on the bubble they created, and they made money when it was coming down.
Hand over fist.
Yes.